Watch video 30 from the Workbook NISM Series 17 Retirement Advisor Certification Examination Final Feb 2024, and review the multiple choice questions and answers. 1. What are the key characteristics of an investment product? A. Return, liquidity, risk, and investment tenure. B. Return, risk, liquidity, and other characteristics. C. Risk, interest rate, and fixed period. D. Guaranteed returns, liquidity, and market value. Answer: B. Return, risk, liquidity, and other characteristics. 2. Which of the following is not a type of return generated by an investment product? A. Periodic return like interest. B. Dividend income. C. Appreciation in value. D. Guaranteed capital growth. Answer: D. Guaranteed capital growth. 3. What does periodic return from an investment include? A. Interest and capital gains. B. Interest and dividends. C. Only capital appreciation. D. Only inflation-adjusted returns. Answer: B. Interest and dividends. 4. Which question helps to evaluate the risk of an investment product? A. Is there a risk of inflation exceeding returns? B. Is the investment liquid? C. Are the returns fixed or variable? D. Is the principal amount guaranteed? Answer: A. Is there a risk of inflation exceeding returns? 5. What is the term used to describe the possibility of not receiving the expected returns from an investment? A. Market risk. B. Default risk. C. Return risk. D. Inflation risk. Answer: C. Return risk. 6. How is the return on investment, ROI, calculated? A. By dividing total capital by periodic income. B. By comparing earnings to the cost of acquiring the investment. C. By calculating the NAV difference. D. By deducting investment fees from capital gains. Answer: B. By comparing earnings to the cost of acquiring the investment. 7. Which of the following contributes to the total return from an investment? A. Periodic interest only. B. Capital gains only. C. Both periodic income and capital gains/losses. D. Guaranteed income. Answer: C. Both periodic income and capital gains/losses. 8. What kind of income is known in advance in investments like debt securities? A. Dividend income. B. Capital gains. C. Interest income. D. All of the above. Answer: C. Interest income. 9. In the case of a mutual fund, how is the return calculated if an investor receives a dividend and the NAV increases? A. Return equals NAV growth only. B. Return equals dividend plus increase in NAV. C. Return equals dividend only. D. Return equals dividend, decrease in NAV. Answer: B. Return equals dividend plus increase in NAV. 10. What is the total return if an investor invests in a mutual fund with an initial NAV of 12 rupees, receives a dividend of 0.80 rupees, and the NAV at the end of the year is 12.50 rupees? A. 0.50 rupees. B. 1.30 rupees. C. 0.80 rupees. D. 12.50 rupees. Answer: B. 1.30 rupees. 11. What happens to the return calculation when the NAV decreases over a year? A. It leads to negative returns. B. It always results in a positive return. C. The return is calculated based on dividends only. D. It leads to capital appreciation. Answer: A. It leads to negative returns. 12. Which of the following investment types may not have both periodic income and capital appreciation contributing to total returns? A. Equity funds. B. Debt products like fixed deposits. C. Mutual funds. D. Real estate investments. Answer, B. Debt products like fixed deposits. 13. In the case of PPF, why is periodic income considered guaranteed but variable? A. It changes based on inflation. B. Interest payable is reset quarterly. C. It provides fixed interest. D. It depends on market performance. Answer, B. Interest payable is reset quarterly. 14. What risk does an investor face if the return earned is insufficient to meet their needs? A. Inflation risk. B. Liquidity risk. C. Default risk. D. Return risk. Answer, D. Return risk. 15. What does liquidity in an investment product refer to? A. Guaranteed return. B. The ease with which capital can be accessed. C. The return on investment. D. The risk of capital loss. Answer, B. The ease with which capital can be accessed. 16. What determines the risk and return in a portfolio? A. The portfolio's holding period. B. The asset class, securities held, and management style. C. The investor's risk profile. D. Only market conditions. Answer, B. The asset class, securities held, and management style. 17. In equity portfolios, what factors affect risk and return? A. Inflation. B. Stock picking strategies and market capitalization. C. Interest rates. D. Fixed dividend returns. Answer, B. Stock picking strategies and market capitalization. 18. In debt portfolios, what influences the coupon income and risk? A. Stock market volatility. B. Credit rating and tenor of the securities. C. Market capitalization. D. Government policy changes. Answer, B. Credit rating and tenor of the securities. 19. Which component of returns is not known in advance for equity investments? A. Interest income. B. Dividend income. C. Capital appreciation or depreciation. D. Return on capital. Answer, C. Capital appreciation or depreciation. 20. If the NAV decreases and an investor receives a dividend, what will the overall return be? A. Always positive. B. Always negative. C. It depends on the extent of the NAV decrease. D. Dividend will offset any decrease. Answer, C. It depends on the extent of the NAV decrease. 21. What kind of income is typically fixed and known in advance in debt securities? A. Dividend. B. Interest. C. Capital gains. D. All of the above. Answer, B. Interest. 22. What type of return does a fixed deposit provide? A. Periodic income only. B. Capital appreciation only. C. A combination of periodic income and capital gains. D. Unrealized gains. Answer, A. Periodic income only. 23. Which investment product's periodic income is guaranteed but variable? A. Fixed deposit. B. Mutual fund. C. Public Provident Fund, PPF. D. Real estate investment. Answer, C. Public Provident Fund, PPF. 24. What is the impact of inflation on returns if not managed properly? A. Inflation has no impact on returns. B. Returns may be inadequate to meet needs. C. Returns always outpace inflation. D. Returns are guaranteed. Answer, B. Returns may be inadequate to meet needs. 25. What does capital appreciation refer to in investment returns? A. The periodic income received from dividends. B. The increase in value of the investment. C. The fixed interest paid by debt products. D. The tax benefits of an investment. Answer, B. The increase in value of the investment. 26. Which of the following is a key component in evaluating the performance of a fund? A. Risk-free return. B. The return earned for the investor. C. Liquidity of the asset class. D. The fees charged by the fund manager. Answer: B. The return earned for the investor. 27. What is a potential risk for investors in debt portfolios? A. Market capitalization. B. Dividend reinvestment. C. Default risk and volatility. D. Guaranteed returns. Answer: C. Default risk and volatility. 28. Which type of investment is likely to have more diversification? A. Equity portfolios. B. Debt securities. C. Real estate portfolios. D. Bank fixed deposits. Answer: A. Equity portfolios. 29. How can an investor realize gains or losses in an equity investment? A. By waiting for interest payments. B. By selling the investment. C. By reinvesting dividends. D. By receiving periodic interest. Answer: B. By selling the investment. 30. Which factor directly influences the coupon income in a debt portfolio? A. The credit rating of the securities. B. The market capitalization. C. The size of the investment. D. The stock picking strategies. Answer: A. The credit rating of the securities.